Have you ever wondered what keeps the world's biggest economy, the United States, humming along? We often hear about stocks, jobs, and inflation, but there's a much bigger, quieter story unfolding in the background. It's a story about debt, trade, and a potential economic storm brewing for 2026. This isn't about fear-mongering. It's about understanding the hidden mechanics of our financial world. So grab a coffee and let's break down this complex puzzle together. I promise to make it as simple and clear as possible. Let's start with the U.S. national debt. It's a number so massive it's hard to even comprehend. We're talking trillions of dollars. Now, for decades, the U.S. has managed this debt by issuing treasury bonds. Think of these as IOUs. Countries and investors all over the world buy these bonds because they reconsidered one of the safest investments on the planet. Why? Because the U.S. has always paid its debts. This global trust is the bedrock of the entire system. It allows the U.S. government to spend more than it earns in taxes, funding everything from infrastructure to social programs. So, who are the biggest buyers of these bonds? For a long time, it was countries with which the U.S. had large trade deficits, like China and Japan. Here's how it worked. The U.S. buys a ton of goods from China. China ends up with a massive pile of U.S. dollars. What do they do with all that cash? They buy U.S. Treasury bonds. This is a win-win. The U.S. gets to finance its spending, and China gets a safe place to park its money and earn some interest. This cycle has been called the Bretton Woods II system, and it has kept global finance stable for years. It's a beautiful, self-reinforcing loop. The U.S. imports goods, exports dollars, and those dollars come right back to buy U.S. debt. But what if this loop starts to break? Over the last decade, we've seen a significant shift. Major foreign holders, including China, have been slowly but steadily reducing their holdings of U.S. treasuries. There are many reasons for this: geopolitical tensions, a desire to diversify their investments, and changes in their own economies. This isn't a sudden crash but a gradual, quiet withdrawal. So if foreign countries are buying less debt, who is picking up the slack? The answer, increasingly, is the U.S. itself. Domestic investors, pension funds, and even the Federal Reserve have been buying more and more of this debt. For now, this has kept the system stable. The demand is still there. But here's where the story gets really interesting and where the year 2026 comes into focus. At the end of 2025, the Tax Cuts and Jobs Act of 2017, a major piece of tax legislation, is set to expire. This means that unless Congress acts, a whole range of tax cuts for individuals and businesses will disappear overnight. This isn't a partisan point, it's a fiscal reality. Regardless of who is in power, there will be immense pressure to extend these tax cuts. Why? Because letting them expire could feel like a massive tax hike on the American public, potentially slowing down the economy right before an election year. It's politically a very difficult thing to allow. So it's highly likely that a significant portion of these tax cuts will be extended. But extending them comes with a hefty price tag. It means the U.S. government will continue to collect less tax revenue than it otherwise would. And what happens when you have less revenue but your spending continues to grow? Your deficit gets bigger. Your need to borrow more money skyrockets. We're talking about needing to issue trillions of dollars in new treasury bonds each year just to keep the lights on. This brings us to the second piece of the puzzle: tariffs. Tariffs, or taxes on imported goods, have become a popular political tool. The idea is to protect domestic industries and reduce the trade deficit. We hear a lot of talk about imposing broad, across-the-board tariffs, maybe 10% on all imports, or even as high as 60% on goods from specific countries. On the surface, it sounds simple: make foreign goods more expensive, and people will buy American. The government even gets some extra revenue from the tariff, but this is where the dominoes start to fall. Let's connect the dots. A policy of high tariffs fundamentally clashes with a policy of high debt. Remember that global loop we talked about? The U.S. imports goods, and the exporting countries use the dollars they earn to buy U.S. debt. If you slap massive tariffs on imports, what happens? The volume of imports will likely decrease. Countries like China, Vietnam, or Mexico will sell less to the U.S. This means they will earn fewer U.S. dollars. And if they have fewer dollars, they have less capacity and less incentive to buy U.S. Treasury bonds. Why would they prop up the finances of a country that's actively trying to block their exports? This is the core of the problem. At the exact moment in 2026 when the US government will need to borrow unprecedented amounts of money to cover its extended tax cuts. One of its traditional sources of funding could be drying up, thanks to its own trade policy. You can't have it both ways. You can simultaneously wage a trade war and expect your trade partners to happily finance your ballooning deficit. It's a direct contradiction. It's like picking a fight with your banker and then asking for a bigger loan. So what happens when the US needs to sell trillions in new bonds? But foreign buyers are walking away, and domestic buyers are already stretched thin? Basic economics tells us what happens. The price of the bonds has to fall. And for a bond, a lower price means a higher yield or a higher interest rate. This is the critical point. The US would have to offer higher and higher interest rates to attract enough buyers for its debt. This wouldn't just be a small adjustment. It could be a sudden, sharp spike. We're not just talking about the government's borrowing costs. US Treasury rates are the benchmark for the entire global financial system. When they go up, everything else goes up too. Your mortgage rates, your car loans, your credit card interest rates, they are all tied to this number. Imagine a world where mortgage rates suddenly jump from 7% to 10% or even 12%. The housing market would freeze. Imagine businesses trying to get loans for expansion, but the cost of borrowing becomes prohibitive. Business investment would collapse. The stock market, which is heavily influenced by interest rates, would face immense pressure. This isn't a slow-moving recession. It's a sudden cardiac arrest for the economy. It's a financial event, as the experts politely call it, a moment of crisis. And because it's driven by this clash of fiscal and trade policy, it could happen without the usual warning signs. The stock market could be at an all-time high and unemployment could be low. But underneath the surface, this unsustainable dynamic would be reaching its breaking point. One day, the Treasury holds a bond auction, and there simply aren't enough buyers at the current rates. Panic sets in, rates skyrocket, and the dominoes fall. So what can be done? This isn't an inevitable disaster. It's a problem of policy choices. The first step is acknowledging the contradiction. Leaders and policymakers need to understand that trade policy and fiscal policy are deeply intertwined. A path of high tariffs and high deficits is a path toward a brick wall. It will require serious, grown-up conversations about the budget. It means making tough choices about spending and taxes, choices that go beyond short-term political wins. It also requires a more nuanced approach to trade. Instead of broad, blunt tariffs, we need strategic trade agreements that benefit all parties. Rebuilding trust with our global partners is crucial, because in a globalized world, we are all connected. Their economic health affects ours, and their willingness to participate in our financial system is what keeps it stable. This isn't about being weak, it's about being smart. For us, as individuals, it's not about panicking. It's about being informed. Understanding these larger forces can help you make better financial decisions. It reinforces the importance of timeless financial advice. Avoid excessive debt, build up your savings, and invest for the long term. A resilient personal financial situation is the best defense against any economic storm, no matter where it comes from. The year 2026 is not a prediction carved in stone. It's a focal point, a year when these powerful forces are set to collide. By understanding the dynamic between debt, taxes, and tariffs, we can see the potential crisis on the horizon. And hopefully, by seeing it, our leaders can find the wisdom to steer us onto a more sustainable path. Thanks for sticking with me through this deep dive. I know it's a lot to take in, but it's incredibly important. If you found this explanation helpful, please hit that like button and subscribe for more content that breaks down the big economic stories shaping our world. Let me know your thoughts in the comments below. See you next time.